hoping for better days, but not before we get through the fear of more gun violence, of keeping our democracy safe, and of a recession. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on just how bad that recession could get and whether there could be something worse coming.
I still do think we have a meaningful amount of inflation that we have to get out of the system.
And Rick Rieder of BlackRock on how we could use the expected downturn to make sure we come back stronger.
It's a very challenging period to think through when you're trying to evaluate risk versus reward.
This week, there was a lot of talk about what could go wrong in Ukraine as European leaders like Italy's Mario Draghi traveled to Kyiv to say Ukraine should join the European Union.
To this purpose, I want to say today that the most important message of our visit is that Italy wants Ukraine in the European Union.
While in the United States, concerns over more gun violence led Republicans and Democrats finally to come together on gun legislation, driven, as Republican Senator Cornyn explained, by constituents demanding action.
Since the shooting, my office has received, as I'm sure many other members of Congress have, I've received tens of thousands of calls and letters and emails with a singular message: do something.
Even as the Supreme Court came down with a landmark decision striking down as unconstitutional New York's license requirement for carrying concealed weapons.
Having a gun out in the open is like, it's incendiary. It will only add to fear, it will only add to conflict and the potential for violence.
And when Congress wasn't doing something to address people's fears about guns, it was investigating a day when lawmakers feared for their own safety, as rioters came within feet of Vice President Pence.
Approximately 40 feet. That's all there was between the vice president and the mob.
But the fear most investors were talking about was the fear of recession, as Fed Chair Powell traveled to Capitol Hill to say it was possible, but not inevitable.
It's not our intended outcome at all, but it's certainly a possibility.
And many investors said it was more than just possible.
A recession is inevitable at some point.
It's almost unavoidable. I got to think that the odds are that there's going to be a recession.
Our economists, as you've noted, this morning have increased their odds of a recession this year.
This inflation is quite bad. It's intransigent. It's not transitory. And the consequence will be a recession.
And if all that weren't enough, on Friday, the Supreme Court came down with its monumental decision overturning 50 years of precedent, deciding the Constitution does not protect any right to abortion, something President Biden called a tragic mistake.
Today, the Supreme Court of the United States expressly took away a constitutional right from the American people that it had already recognized. They didn't limit it, they simply took it away. That's never been done to a right so important to so many Americans. But they did it. It's a sad day for the court and for the country.
While Republican House Minority Leader Kevin McCarthy found it the ultimate affirmation of American values.
The voiceless will finally have a voice. This great nation can now live up to its core principle that all are created equal, not born equal, created equal.
And a good part of American business was quick to respond, with companies like Amazon, Apple, Disney, and J.P. Morgan pledging to do all that they could to support their employees getting abortions in states that still permit them. Equity markets picked this tumultuous week for something of a rebound in a bear market, with the S&P 500 up 6.5% on the week, the Nasdaq up a cool 7.5%, while bond yields came back under control a bit, with the yield on the 10-year coming down to 3.13 by the end of the week. Here to sort through it all with us are Jim McDonald, Northern Trust Chief Investment Strategist, and Kristina Hooper, Chief Global Strategist at Invesco. So welcome, Jim and Kristina. Great to have you here. Kristina, let me start with you on what happened with bond yields, because they had been really ramping up. There'd been a lot of volatility. They settled down a bit this week. Is that because of a fear of recession?
I do think that what we're seeing is concerns about at least a slowdown. I don't know if it's exactly a recession. I would argue that we'll still be able to avoid a recession in the United States. And one could argue that that's what the bond market is telling us. The spreads between the 2-year and the 10-year yield are still positive, even though they've flattened a lot. There's a very big positive spread between 3-month and 10-year yields, which some might argue is an even better indicator of whether or not we go into recession. So clearly pricing a slowdown, but I don't believe a recession.
So Jim, isn't that exactly what the Fed wants, is a slowdown, maybe short of a recession?
Absolutely. And so I think the softness in commodity prices in recent days has also contributed to the moderation in bond yields. And the Fed has tightened financial conditions dramatically. And all you have to do is look at what's happened to mortgage rates and the impact on the housing market that is starting to have to understand that the Fed's impact is already starting to make a difference.
Well, I wonder, Kristina, we got University of Michigan consumer sentiment numbers out on Friday, and they came off a little bit, actually, on the longer term 5 to 10 year expectations on inflation. Are we starting to see some effect of the Fed, do you think?
I do think we are. I mean, but we're also just starting to see a reflection of some commodity prices, energy prices easing a bit in the last several weeks. So I think that is reflected in it. I mean, Jay Powell even said in that FOMC press conference that there is a pretty strong correlation between energy prices, headline CPI essentially, and inflation expectations for consumers.
Jim, how much of the concern about inflation actually comes right off of energy, just straight off of energy?
I think it's extremely high. I think if you look at the correlation between gas prices and the Michigan survey, it's really high. It's the most visible demonstration of what energy costs are to the consumer. And so I think it's going to be a critical point to inflation expectations and bond yields over the next year that we see at least a flattening, if not some moderation, in gasoline prices.
Yeah, and I would expect that we see some moderation in longer-term inflation expectations going forward. And I think it's very important to recognize this is very different than what we saw in the 80s and 90s. Before those recessions, we saw inflation high, and yet long-term inflation expectations were just as high or nearly as high as the one-year inflation expectations. That's not what we're seeing today. Longer-term expectations are well anchored or relatively well anchored, and that's what the Fed is looking for.
Jim, what we didn't have is, go ahead, please.
So, David, I would add that this is such an unusual period because we're dealing with these supply disruptions that are not really possible to confidently forecast. The disruptions coming out of Ukraine are still in place, and they could get worse. Russia has started to turn down the gas to Europe, and you don't know what they're going to do with that. And the agricultural season is coming towards harvest, and we don't know how they're going to get the grain out of there. So while there's a good case to be made that we will see inflation coming down, the risks around it are very atypical at this time of the cycle.
I wonder about that specifically because you heard, for example, Senator Elizabeth Warren this week asking Jay Powell, the Fed chair, saying, what can you do about gas prices? Is there anything you can do effectively? Because it's not clear the Fed can do anything about those supply chain problems that Jim's talking about.
Well, the Fed can't do anything really about energy prices or commodity prices either. But what they can do, and what he said in his testimony, was that they could soften demand for things, for durable goods. And that will have some impact. So I anticipate we'll see elevated inflation, but it should start to moderate from where we are.
But can the consumer keep up? I mean, because so much of the economy is driven, Kristina, by the consumer. They're spending down their savings right now. How far can they go?
Well, it all depends on exactly the trajectory of this slowdown. So we have a very tight labor market, which I think is the biggest advantage we have. And we have more job openings than we have job seekers. So theoretically, if the Fed cools demand, we could see companies react not so much by layoffs, but by removing job openings, job postings. And in that way, they could navigate a soft landing. I also think it's critical that the Fed is data dependent. I mean, and we saw that on display. It wasn't just words. The Fed reacted to essentially 2 data points and made a pivot in terms of how much it hiked rates at the last meeting. That could happen in the other direction as well. I think it's great that they're going to be reacting to incoming data. I think it enables what is a blunt instrument, not a surgical tool, to become at least a little bit more like a surgical tool.
Jim, what about currency? The dollar has been on something of a tear as a practical matter. I'm not sure how long the rest of the world can put up with that. Is there a danger of a reverse currency war here?
I think there absolutely is a major impact from that. It is going to lead to a curve of inflation in the U.S., but it's going to really hurt growth outside the U.S. and hurt the ability of those companies to service their debt. So I do think that that's got to be paid a lot of attention to. It is an important part of the financial conditions index. And so the level of strength that we've seen so far will absolutely help slow growth in the U.S. along with inflation.
So, Kristina, what about those financial conditions? Jim's mentioned them before here, and I saw a chart that Northern Trust had actually showing financial conditions have tightened a lot more than they have in the last 4 or 5 rate hike cycles, actually, although I think the inflation rate was much higher this time than those times as well.
Well, yeah, and the Fed is doing what it hoped to do. And it actually started doing that with talk, which is great when talking can do some of the heavy lifting. And so immediately, really at the start of this year, when we heard that the Fed was planning on reducing the size of its balance sheet this year, that's really when we started to see financial conditions tighten, and it has continued since then. That suggests to me the Fed may be able to get away with fewer rate hikes than it currently projects, because it has done a very good job tightening financial conditions.
Jim, Kristina raises, go ahead, please, Jim.
So here's a great example of the impact the Fed's moves will have. They will probably hurt GDP by roughly 1% by the decline in housing activity because of the jump in mortgage rates. Probably won't hit house prices as much, but there clearly will be a slowdown in activity because of not only less construction, but less remodeling, less broker commissions, et cetera, all tied to the fact that mortgage rates have had a historic percentage increase in the last 6 months.
Okay, Kristina Hooper of Invesco and Jim McDonald of Northern Trust will stay with us as we take a look at the markets, at what they did to us last week as opposed to what they can do for us next week. And by the way, we'll pick up exactly on housing where Jim just left off. That's next on Wall Street Week on Bloomberg.
Everyone's looking at housing and saying it's too high priced and labor costs too much and the materials are too much and the land is too much, and they all sit there and they say, isn't that terrible? What are they going to do about it?
That was Pierre Rinfret of Rinfret Boston, appearing on Wall Street Week way back in 1976. And it looks like we're back to some version of that world again, with higher prices and higher input costs for housing. But a slowing economy, and Fed Chair Jay Powell told us this week, a slowing housing market as well. Still with us are Kristina Hooper of Invesco and Jim McDonald of Northern Trust. Jim, this is exactly where you left us off on the housing market. We heard Jay Powell this week say, yes, it is slowing. We could even have housing prices go down, at least in some markets. How big a drag, potentially, even a danger for the economy, is the housing market?
I think the danger is more from the volume standpoint than it is from the price standpoint. If you think about housing today, it's about 4.5% of the economy. It got to 6.5% during the bubble. So we're nowhere close to that level of an impact. And what I think will provide some cushion to the downside on prices is that inventory is incredibly low. Vacancies are very low. So while the jump in mortgage rates really hurts affordability, there is just a mismatch between demand and supply that I think will put some downside underneath prices.
And I think it's going to take a long time to work through that and get to the point where supply meets demand, especially given all the supply chain issues we're currently experiencing. It's just not an environment in which we're going to see a lot of homes built, especially first-time home buyers' homes.
So, Kristina, give us a little investment advice here, right? That's what we really want. We're saying we're clearly going into a downturn. We don't know how bad it'll be. At the same time, we know we'll come out of it at some point. As an investor, what do I do in the short, intermediate term to make sure I'm protected? But as important, perhaps more important, what do I do to position myself to come out of that downturn stronger than ever?
Well, I think it's a great question. I think it's great to look at it essentially in 2 phases, because what we're experiencing right now is this significant drop in the stock market and actually a significant drop for some fixed income. And what has driven that is expectations about an economic slowdown, whether or not it's an actual recession, a slowdown. We know that markets tend to signal economic events before they happen. So I think that before long, long, certainly before the end of the year, we'll start to see a stock market recovery in anticipation of an economic recovery next year. And so I think we have to keep that in mind. Too often investors have gotten spooked. Look at the global financial crisis, how many people got out towards the bottom, locked in losses. I think it's critical to be forward-looking and think of this time frame as actually a time to start looking for opportunities, to start dollar cost averaging. I think you want, over the shorter term, to have a pretty neutral stance when it comes to risk, but start to look and start to allocate for that recovery, because the recovery, I think, is going to be longer lived than the downturn.
Jim, right now, a lot of people are talking about high yield because of the returns you're getting on high yield right now. What, over 7%, maybe 8%, something like that? Is that a place we want to be right now?
I think it is, and if you want to be defensive in this environment, high yield bonds provide about 1/3 of the downside risk that equities do. And an important distinction is, do you think of high yield as a fixed income alternative or a risk asset alternative? And we think of it as a risk asset alternative. So if we go into recession, high yield bonds on average have declined just 4.5% during the past 6 recessions, whereas US equities are down over 12%. And you're getting a current yield to worst of roughly 8.5%. So when people say, how can you buy high yield bonds if we're going into a recession? The answer is, if you're trading out of equities into them, it's a less offensive position, but you don't want to trade out of investment grade bonds into high yield if you expect we're going to go into a recession, because investment grade bonds have historically done very well in that environment.
But I think when Jim talks about U.S. equities, he's talking about a broad basket. And I think what we need to do in the shorter term is be more defensive in our equity exposure. So in U.S. equities, having more exposure to what I would call defensives and secular growth, including healthcare and technology. And so that could be actually, after especially significant losses in technology, could provide a slightly different risk-reward profile than an overall general U.S. stock market basket.
So, Jim, what about that, defensives in equities?
Yeah, so the one nuance I would add to that is that we still like the natural resources sector, commodities-oriented, energy stocks, for example. They're a nice hedge against our number one risk case, which is sticky inflation. We don't know when these supply chain problems are going to get fixed. You keep hearing about more issues in the energy patch. For example, what's going on in the Ukraine and the big steel production facility in Mariupol that is probably shut down, and so they're not able to provide the steel tubing that goes into oil exploration. All of those things tell us we want to have some hedge in energy, and we do like technology. That's a recent upgrade for us for the secular growth reasons. We expect technology to grow its share of GDP over the next decade by roughly double.
Well, no, that's really interesting, because there's sort of the bloom's been off the rose of a lot of technology recently. After a really great run, sort of come off again. Where are you in technology, Kristina?
I'm very positive on technology. Now, I think we need to be selective. Yeah. We want to stay away from what I would call spec tech, which was actually the first leg of technology to fall. But there are a lot of great names in that space, some of which look like very good buys right now, given where valuations are and given strong cash flow, just solid fundamentals in general.
Jim, you also, I know, have said that you like infrastructure investment. What does that look like?
So it's a global basket of companies that help provide the infrastructure to energy, to electricity generation, to transportation. They generally have got a very good ability to pass through inflation through price increases. They tend to have a much higher yield than the overall market. So it is a little bit more of a defensive way to keep some equity exposure, but also benefit from the inflationary trends that we've been experiencing.
And Kristina, what about the longer term trends? Again, coming out of whatever downturn there is here, what do you think is promising? Are we talking about things like green energy? What are we talking about?
So I certainly think there are a lot of different themes that are very exciting. Some are smaller than others. Green energy is certainly one of them. Cybersecurity is one of them. But I think I would take a step back and say the bigger picture is that we're returning to a more normal environment. And when I say more normal, more normal relative to longer term history. And so that suggests to me an environment in which there is more diversification offered by fixed income, higher yield offered by fixed income, but still adequate returns from stocks. We're going through an adjustment period right now. That's not fun, but I'm very excited about the future and what it holds for investors.
Jim, more normal certainly sounds pretty good to me right now. At the same time, how much of that depends upon the Fed not overreacting? Because some people say the Fed's had a really big say in the markets thus far. Getting back to neutral, fine, a little above neutral, fine. But if we're really going well above that to 4 or 5%, what is that going to do?
Yeah, so I would define overreacting a little differently. I would say that if they end up doing that, it's because inflation has proven to be more persistent, and so their action is actually justified. And that is not going to be a good circumstance for the market. If you think about bear markets, there really are three categories: an event-driven one, which is the least damaging. Secondly, you can have one that is more cyclical oriented, and then you can have one that's driven by a financial crisis where credit creation is impaled. If the Fed hikes rates too much, we're definitely going to go from what's an event-driven to a cyclical type of recovery. But if you look at the Fed stress test results over the last 24 hours, the banking system is in really good shape. So we are very unlikely to get into a structural bear market, which can be really damaging.
Okay, that's pretty encouraging to me. I'll take that to the bank, no question about it. Really appreciate Jim McDonald of Northern Trust and Kristina Hooper of Invesco being with us here today to really give us an insight into what the markets have done, but also what they're likely to do in the future. And now, coming up next, we're going to take a look at the week ahead, and that is on Global Wall Street. What does it hold in store next week? That's coming up next on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to look ahead to next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thank you, David. China's June PMI should reinforce the message from recent data that the economy is recovering from its Omicron-induced slump. Bloomberg Economics sees the official manufacturing and non-manufacturing gauges both likely to climb back into growth territory for the first time since February. Meanwhile, we are on inflation watch with reads due from Tokyo, Indonesia, and crisis-stricken Sri Lanka, which could see inflationary pressures top 49% in June. Now over to Danny Berger in London. Danny?
Thanks, Juliet. It will be all about, much like the U.S. last week, looking for signs of recession in Europe in this coming week. It's after last week we had Germany raising its alert level when it comes to gas, potentially passing on the cost to consumers and companies. How will that add to inflation? What does that mean for recessionary signals? BlackRock, for its part, thinks that the odds are now on for recession in Europe. So any more signs of that, any more development, especially when it comes to energy and the ECB, will be closely watched in Europe. Now over to Romain Bostic in New York.
Thanks, Danny. Economic data in the week ahead include retail inventories, auto sales, and orders for durable goods. But most of the attention will be on Thursday when personal income and spending data are released alongside the Fed's preferred inflation gauge, the PCE deflator. Like the CPI data, the PCE index tracks things that are consumed by Americans, but unlike the CPI, it is based on business surveys and is less heavily weighted towards housing costs and more so on things that consumers don't directly pay for, like the cost of subsidized health care. That PCE deflator has been at or above 6% for 4 straight months and at 4% or higher since May of 2021. Fed speak next week includes scheduled public appearances by St. Louis Fed President James Bullard, Cleveland's Loretta Mester, and San Francisco Fed President Mary Daly. And a few earnings reports to keep an eye on. Nike, McCormick, General Mills, Walgreens, Constellation Brands, and Micron are all scheduled to release their fiscal quarterly results next week. David?
Thanks to Juliet Sally, Danny Berger, and Romain Bostic. Coming up, we know things are rough and likely to get rougher. But what can investors and policymakers do to make sure we come back stronger than ever when things do turn around? We ask Rick Rieder of BlackRock. That's next on Wall Street Week on Bloomberg. We can disagree about just how bad it will get.
There's a chance that we are already in a recession.
Is it severe? Is it drawn out?
A shallow recession versus a deep one.
There's nothing inevitable about a recession.
But no one can deny at this point that the economy will slow.
Well, I expect the economy to slow. It's been growing at a very rapid rate. It's natural now that we expect a transition to steady and stable growth.
And the markets could continue to fall, at least for a while.
We've done a lot of price damage, right? We want to be investing into the price damage, but we think it's premature if the risk of recession is still increasing.
But however bad it gets, and however long it lasts, things will come back, raising the question, what have we learned from the experience, both in the policies we adopt?
My most important advice to the administration is don't do anything to shock the economy.
And in the way we invest.
I think we're going to see a lot more investors remain on the sidelines, remain cautiously positioned, and that actually may lead to some interesting opportunities for longer-term investors. And to take us through where we are, and more important, where we are headed, we welcome now Rick Rieder. He is the CIO for Global Fixed Income and also head of the Global Allocation Team at BlackRock. Rick, thanks so much for being here.
Sure, have me.
So before we start about how we come out of this stronger, let's talk about where we are right now. Where are we?
Listen, I mean, for markets and for the economy, we're in one of the most uncertain periods we've been in a long time, and well, quite frankly, in a generation. We have never had an experience where our economy is tangibly slowing across almost every piece of data. Economy is slowing. You're starting to see it work through in the claims data and the unemployment data, and we think over the next couple of employment reports, you're going to see an economy or hiring dynamic that's different. And you've got a central bank that's got as its singular focus today, despite the fact its dual mandate is full employment and price stability, that has got to bring down inflation. So it is a construct that the markets have a hard time dealing with. How much will they let the economy go? How much with inflation, which we think will come down? You're certainly seeing indications of that. You're seeing in the market's pricing of it. So it's a very challenging period to think through when you're trying to evaluate risk versus reward. What are interest rates do in a portfolio? What are stocks, high yield bonds do in a portfolio? And I think the markets haven't reconciled the solution to that yet.
And how much of that is the markets and the underlying economy, and how much of it is policy? I know that BlackRock has a terrific chart basically indicating, it surprised me, in recent years the volatility in monetary policy has driven the investments more than the investments have.
So David, it's a pretty incredible thing, and part of what we're trying to illustrate on this report is if you've been investing 20 years ago, 10 years ago, it was all about the central bank's reaction function to the economy and how the central bank would react when inflation or employment moved too far away from normalcy. The last 10 years, and certainly anybody we've hired or worked for us that's been there 10 years, has been an environment where the central banks are functionally all you have to focus on because they are driving the dynamic around how prices are moving. Why is that the case? I mean, listen, you need aggressive monetary policy. When you go through a financial crisis or you go through a pandemic, you need aggressive policy. But there's been this process of tweaking to get back on the line that I would argue is creating more volatility to markets. You know, I would argue, including this central bank, including the Fed, we need to get to neutral quickly. Get to neutral. The system has an ability to recalibrate itself, be flexible. I would say high prices are the cure for high prices. The U.S. economy is incredibly adaptive, and you're seeing it. It was a good article today about, you know, you look at gas prices higher, consumption comes down. The system recalibrates, but we've become used to the central bank is kind of trying to put us back on a line of 2% inflation and full employment. And I would argue it's actually creating more volatility at times than is warranted by how much the economy actually gyrates.
When you say get back to neutral, we heard from Chair Jay Powell in his testimony before Congress this week saying he still thinks neutral is around 2.5%. But even he is saying now we may need to go above that. You have other people saying we need to go way above it in order to really put a stake through the heart of inflation. Is that wrong?
Listen, I don't think you have to go way above it. I think the chair is right. And I think what they're doing now is exactly the right policy. I know I and others have been critical about we waited too long to move, and I think the Fed has been clear on that being the case. But there's a question of what is the trade-off from if you get to neutral and get a bit beyond. We shouldn't be at easy policy like we are today. Get to neutral, do another 75, get closer to neutral, maybe do a 50 on the back side of that. You know, you think about what you could do, fiscal policy, solar, battery. You've seen some developments recently. What you could do in precision ag to help the food market, multifamily housing incentives to build more multifamily. Housing affordability is really hard, is really expensive today. Multifamily is going to be, people are going to stay in rental. We need more development of multifamily. These are fiscal initiatives that need to come in and can be, and by the way, have a real velocity to them, create multiplicative economic impact. Just keep raising rates and taking people out of work. It's a blunt tool, and maybe it doesn't work, and maybe it doesn't bring the inflation down. I just don't agree. I think the Fed should get to neutral, maybe a bit through it, as the chair has said, and then see where you are. How fast is the economy slowing before you say, gosh, we got to go so far past. I just don't agree with that.
So, Rick, that's some advice for the policymakers. What about for investors? Give us some investment advice here. Where are we right now? For example, you allocate both for equities and for debt. You have fixed income. You do both. Where are we right now in the 60-40?
So, I mean, one of the most interesting things is the interest rate markets. The interest rate market has decided that the Fed will never get to do what people are saying and go much further. I mean, this week was extraordinary about how the market said, okay, the Fed's never going to get to do it. The economy's slowing. And it's almost as if the Fed announced they're easing how fast rates are coming down. So I think the market has said you're not going to get there around because the economy's slowing too fast. Listen, I still think you have the risks in interest rates. I think the central bank is going to try and get rates higher. So, do you take a lot of interest rate risk today? I still think you have to be moderate in terms of your interest rate exposure. So we're keeping that down. The equity market, is still the liquidity, the uncertainty. It's just okay. And we're looking at certain areas that we think are durable that have really gotten hit. Some parts of the technology area, like software, where companies need to be more efficient to bring their costs down. So I think they're parts of the equity market. The credit markets have become really interesting. And, we've started to add some in credit. I mean, you can buy high yield now back at 9%. So think about real rates. We lived in a zero interest rate world, and your high yield was trading at 3.5, 9. You're starting to get, I still think you got to be careful in portfolios. You still got to run a high level of cash. You still got to let things work through around these uncertainties. But we're letting our cash run down a little bit by a little bit more credit. And, but I still think you got to be patient and let things play out. We're going to get a lot of data on the economy, a lot of data on monetary policy. By the way, not just in the U.S., Europe is going through a more significant slowdown than the U.S. China's evolving. So there's a lot to come in the next couple of months. We think taking a little bit more risk, but not racing in, I think makes sense.
BlackRock also had an interesting chart comparing private credit with high yield.
Yeah. So it is an extraordinary thing that I have, quite frankly, haven't seen in my career nearly to this extent, maybe at all. That some of the private markets are slower to adjust, and people say they're less volatile. I don't know why less liquidity means they're less volatile. Organically, you don't mark them to market as much. But it's interesting, and I keep seeing private investments brought to us, and I ask the question, have you seen the public markets? Like, why is that pricing where it is? So, I think I think two things have to happen. One, my sense is the public markets will stabilize and start to improve when we get a sense for the Fed and the ECB are going to slow down the policy adjustment. So that improves. And then I think the private markets need to, their rate of return hurdles have to increase a bit. The cost of illiquidity has to go up a bit. So my sense is both will happen. But right now there's this weird, it's sort of like when people sell houses, you just step back and don't sell them for a while because you don't like the price. And I think some of the private markets, they need to adjust a bit. And I think both will happen. But I think that adjustment period takes some time.
Okay, Rick, thank you so much. That's Rick Rieder, BlackRock. Always great to talk to Rick. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we welcome back once again our very special contributor, Larry Summers of Harvard. So, Larry, a good part of the week this week was given over to talk about recession on the one hand and inflation on the other. We heard from Fed Chair Jay Powell for 2 straight days up on Capitol Hill. Let me ask you the most basic question. As you look forward to the economy, what do you think the biggest risk is right now we face?
Look, I think, David, that a recession is almost inevitable. Probably a 75%, 80% chance within the next 2 years, and there's certainly a real risk that it will come sooner. That's going to be a very difficult thing, though, as I say, I think it may be inevitable given where we are. But I think it's going to be very important to make sure that if we're going to go through a period of pain, we do slay the inflation dragon. You know, there have been many failures, particularly the 1970s are the classic example of where economic policymakers did the equivalent of stopping their antibiotic when they felt better, but before the 10-day dose was through. And so it's a very, very difficult set of balances and challenges that the Fed's going to have, and I very much hope that they make wise choices.
So I take your point that the only thing worse than having a recession is having one without slaying the inflation dragon, as you say. But let me ask you, at this point, some people are predicting this will be a fairly short and shallow one. Do we have reason to believe that?
I hope they're right. I think the question's going to be how much recession is going to be part of eliminating inflation, and that goes back to the whole debate about team transitory. If most of inflation is transitory, then we're not going to have to live with very much pain to get the inflation out of the system. If more of it is more ingrained, then we're going to have to live with more difficulty. I was mildly encouraged by the number that came out today suggesting that long-term inflation expectations as measured in Michigan had gone up a little less than people originally thought. But I still do think we have a meaningful amount of inflation that we have to get out of the system. And I don't think we're going to do that in 1 or 2 quarters of economic slack. But look, there is no reason why this needs to resemble the recessions of the last generation. This should not be anything like what happened after COVID. This should not be anything like what happened after the great financial crisis. Just how deep, just how long it will be, difficult to know, but most people remember the last 2 recessions, and I don't see any reason why we're headed for difficulties of that kind.
One of the things that Chair Powell testified about this week was neutral rate that he still thinks is about 2.5%. I wonder if you agree with that. And then going on to say we may have to go somewhat over that. Some people think he has to go well over that. Where are you?
Look, I think that talking about the neutral rate without talking about the rate of inflation is basically illogical. And so when he says the neutral rate is 2.5%, he's assuming that the inflation rate will be 2%, which I don't think is to be assumed without the right kinds of policies. So my guess is we're going to have to go well above 2.5% on interest rates. Ultimately, in the long run, when we get through this inflation episode, I think there's a substantial chance that we're going to return to the kind of secular stagnation situation we had before COVID, which could mean a neutral rate below 2.5%. So I think we're going to have to be very careful and monitor to track what's happening. But I wish Chairman Powell would start framing the neutral rate as a real interest rate concept that at any moment is dependent on the underlying rate of inflation, and stop just using a nominal figure that assumes so much of what is at issue.
Staying with Chair Powell's testimony again, he also testified a fair amount on both days of the hearings, actually, about the housing industry and the fact that necessarily the increased rates are hurting the housing industry. He even suggested that at least in some places in the country, we may have housing prices go down. How big a threat is that to the economy? Because that is something we saw back during the great financial crisis.
I think we're in a much less precarious situation in housing than we were during the great financial crisis. But house prices have run way up, and I wouldn't be surprised, given what's happened to mortgage rates, if at least in many parts of the country there was some backtracking of house prices. My assessment is that that's not going to pose the kind of systemic financial risk that it did during the great financial crisis. But as is always true when there's excess, the people who get in last find it expensive. And I suspect that there are going to be people who hit the top when they bought houses sometime in the last 3 to 6 months. And I wouldn't be surprised if for some interval they see a decline in the price of their house.
Larry, quite beyond any testimony up on Capitol Hill, we also had two very dramatic opinions come down from the Supreme Court of the United States. I know that you're not a constitutional lawyer, at least not that I'm aware of. At the same time, I wonder what you think about that decision with respect to the Second Amendment and guns, and also then at the end of the week with respect to abortion. You have talked on this program before about your concerns about the institutions of democracy in this country.
I'm worried about a Supreme Court that so radically breaks with its own precedent, that is so fully in the life of the country. And I wonder if that doesn't raise questions more broadly about the predictability and continuity of policy, the extent to which there are very strong checks and balances in our democracy. By my personal values, both these decisions were appalling, but everyone has their values, and there are other people who would have very different values. What I think is in some ways the more fundamental issue is this question of reversing precedent and mandating things that have really not been acceptable for many years. I can't help but feel that the decision that it's illegal and unconstitutional to stop people from carrying concealed weapons, that goes a long way for me. And I think Roe v. Wade has been so much part of American life that to remove it completely in the way they did with a completely divided court is a kind of fairly shocking act. And I say that as someone who believes very much in deference to the court. I was not one of those who attacked the court for the Bush v. Gore decision, though it was not a decision I liked or supported. I was not one who was prepared to attack the court for the decision they made in Citizens United, the case about corporate funding of politics, though that was a decision that I didn't like. I think these really are quite radical decisions of a particular kind in terms of changing longstanding Supreme Court views, and that does concern me in very fundamental ways.
Larry, let's wrap up with one of your favorite pastimes, golf. I remember you got a hole-in-one this year, as I recall. We have this real dispute now in professional golf between, on the one hand, the PGA, and the other hand, live golf. What do you think about what's going on with that new upstart?
David, in some ways, it's a fight between the highly entitled and the highly privileged. But I think it says something really quite interesting about our broader economy. When you had the PGA with a monopoly, you had a certain distribution of rewards between golfer number 3 and golfer number 103. Now, when the whole thing gets competitive, the superstars are going to get more if they go to the LIV, and in order to keep them, they're going to get more staying with the PGA. I think that's a metaphor for a lot of what's happening in our economy, whereas there's more and more competition, more and more ability to discern who the superstars are, there's some pulling away of the superstars and some loss of solidarity, not as a consequence of market forces. And that's a very difficult thing to think about because there's a lot of efficiency coming from those market forces. It's why I think having a progressive tax system is so much more important, because I think we should be allowing the kind of competition for the greatest talent that this thing represents, but that at the same time we want to have a society where there's some degree of solidarity and everybody has a chance. And so allowing market forces to operate with progressive taxation is, I think, the right answer.
Okay, Larry.
More progressive taxation.
Larry, thank you so very much. That's our special contributor, Larry Summers. He is, of course, from Harvard University and also an avid golfer. Coming up, borrowing from the 80s. We've got the inflation, we've got the war. Are we also going to bring back the labor unrest? That's next on Wall Street Week on Bloomberg. Finally, one more thought. Everything old is new again. We have had more than our fair share of historic moments these past few years, from a once-in-a-century pandemic.
It is 10 times more lethal than the seasonal flu.
To an economy falling off a cliff and then bouncing right back again.
The strongest economic recovery in the world.
To a ground war in Europe, the likes of which we have not seen since World War II.
This crisis directly affects every member of this council and every country in the world.
And inflation higher than it's been in at least 40 years.
Inflation is hitting people so hard, they're coughing up bones.
If all that weren't enough, now we have the return of labor unions and even of strikes. As this week, Great Britain saw unions shut down part of its rail system.
Britain's biggest rail strike in 30 years starts today after unions rejected a last-minute offer from train companies.
Bringing back more memories of the 1980s and British Prime Minister Thatcher's uncompromising stand.
What we have seen in this country is the emergence of an organized revolutionary minority who are prepared to exploit industrial disputes, but whose real aim is the breakdown of law and order and the destruction of democratic parliamentary government.
But now, 40 years later, the move back toward unions involves businesses that we didn't even conceive of in Lady Thatcher's day. Now it's our half-calf, no-foam lattes that could be at risk, as Starbucks baristas move to organize.
Starbucks has now lost several rounds of this legal fight at the Labor Board.
And then there's the question of who's going to fix our iPhones if the people at the Apple Genius Bar all join the International Association of Machinists and Aerospace Workers, a trend that a former NLRB chairman says is far from over.
I think it's likely that it will happen at many more stores. We don't know really how many it's likely to be, but clearly something is happening.
It may be no coincidence that what we're seeing today comes at a time when we have a president deeply committed to organized labor.
I'm proud of it. Look, you know, workers have a right to determine under what conditions they're going to work or not work.
But then again, back in the 80s, when things went too far, we managed to do without our air traffic controllers, albeit with a very different president.
If they do not report for work within 48 hours, they have forfeited their jobs and will be terminated.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.